All right. Hello, everyone. Thanks for attending. I'm Kevin Davey, KJ Trading Systems, and today we're going to talk about multiple ways to trade the mini S&P. So I want to thank you again. And questions, you can type in whenever you have them. I probably won't get to them until the very end, though, because there's a lot of people here today, and so I don't want to take away from the presentation, but I will stay as long as I need to afterwards and try to get everyone's questions answered. So with that, what we're going to talk about today is, first of all, who I am, for those of you who don't know me. And then, I mentioned 7 different ways to trade the mini S&P. And so but before we get into that, we're going to talk about why you would do that in the first place. Why multiple strategies, because that becomes important. Then we'll actually talk about the 7 ways, and then I'll talk about something I teach, which is called a strategy factory. And we'll do a book giveaway, and then we'll get to your questions and answers. So a lot of stuff to cover today, and let's get going. All right, so first we have the friendly U.S. government disclaimer. I know you guys have seen this a lot, but it's important. It's important stuff, and there's a lot of important things in there. And probably the biggest thing in regards to what we're talking about today is the second paragraph where it says hypothetical or simulated performance results have limitations. And what I always tell people is, unless it happened in your own account, treat it as hypothetical, because your next door neighbor could be trading too, and he could say, oh, look, I took this trade today, it made $1,000, but if you didn't make it, it's hypothetical to you. You could have made it, maybe you wouldn't have, maybe something would have happened, who knows? So keep that in mind. What you want to do is treat everything as hypothetical. That's the best way to go. All right. So who am I? First and foremost, I'm a full-time trader. So I do writing, consulting, some teaching. All that stuff is all part-time for me. My full-time job is really a trader, and that's where I focus most of my attention, developing strategies, doing day-to-day trading, that kind of thing. I've been trading for 25 years, and the last 8 or so, I think, have been full-time. So I was able to make that leap from hobby, part-time trader to full-time trader, which is really kind of cool. It's kind of everyone's dream to go from part-time to full-time. So I was able to do that. And 3 years in a row, I finished first or second place in the World Cup of Futures Trading Championship. That's a year-long real money, real-time contest against some of the best traders in the world. Larry Williams, the legendary trader, won it a number of years ago. He had like 10,000% in the year. I've only done 100% in each of those 3 years, which is still pretty good, but nowhere near what he did. But in any event, it's a tough contest against some good traders, so I was able to do pretty good in that. And that was actually before I went full-time, and so that kind of gave me some incentive to, or some confirmation that, hey, maybe you can do this full-time, and it's kind of neat. So anyways, you might have seen me profiled as a market master in the book, The Universal Principles of Successful Trading. And if you're a beginning type trader, and or even an intermediate trader, this is a great book. It's written by Brent Penfold, and he manages some funds down in Australia and trades his own account. A really nice book. And if you read Futures Magazine, which is now called Modern Trader with its last issue or so, you probably have seen my articles. I've had quite a few of them this year, and I think I might have like 3 or 4 more this year. So all different topics in trading, see me there. And if you frequent any trading forums, the one I recommend is Big Mike Trading, because the people are not abusive there, especially to newer people. It is a nice trading forum, and I'm Kevin K-Dog there, so you might see me lurking around sometime answering some questions. Okay, and here's my book. I wrote a book back in 2013, and it actually won. I mean, sorry, it wrote it in 2013. It was published in 2014, and it won TraderPlanet.com's Trading Book of the Year award in 2014. It's called Building Algorithmic Trading Systems. So the first part kind of talks about my journey of trading. The rest of it talks about how I developed trading systems. Van Tharp read it, and he said it was a very impressive book. And you know, for those of you who know me, know I follow a lot of what he does, and he's got a lot of good points. So that was kind of neat. And then a couple other traders who have also won the World Cup, Andrea Unger and Michael Cook, two very good traders, and Michael actually runs a CTA. They had some good things to say about it too. So some pretty esteemed people have said some good things about this book. And it's got some pretty good reviews off Amazon, and it's still hovering around the top 10 or so in sales bestseller list for futures books. And of course, that's a picture of me with the background of where I live in Cleveland, Ohio. But with that, you know, I mentioned we're going to do a book giveaway later, and I will give away an autographed copy later. But what I'd like to do right now is give away an autographed copy to, and I'll send it to you no matter where you live in the world, to the person who answers the next question. And I think I'm taking the 5th correct answer. So if you know the correct answer, type it in the chat box or the question box. Actually, you can use the question box. Why don't we use that? And so it'll be the 5th person to type it in, and they'll get an autographed copy of my book, and that is the name of my website. So just type in the name of my website, and the 5th person who does it will receive a copy of this book. So 1, 2, 3, 4. Okay, it looks like Marvin is the winner. So congratulations to Marvin. And in case you didn't know the answer, it's right down there. It's KJ Trading Systems. So, you know, I have a lot of good articles there, videos, a whole bunch of free stuff. So feel free to join in there. Take a look. All right, so that's my book. It's kind of a little bit about me. What about my trading history? I'll tell you what, the first 10 years, I bet I did everything the wrong way. You know, everything they say not to do. And at the time I was doing it, a lot of this knowledge wasn't even out there, but over-optimizing, too many rules, not enough data, you know, limit order fills, also, you know, no slippage, all sorts of stuff. I did it all. I made all kinds of mistakes. And what it led to was I spent a lot of time doing a lot of research and trying to figure out, well, how could I avoid all this? And that eventually led me to where I am today. I kind of took my personality and what I like to do. I'm more of a numbers person. I have an engineering and an MBA background, so I'm more numbers oriented. So that's some of my own personality, and I put it together, and that led me to where I am today. And you know, over that period of time, I had a bunch of breakthroughs that things that just clicked all of a sudden. And one of them was when I realized that trying to create one great strategy, you know, the strategy that would be the holy grail that would rule the trading world, really just wasn't possible. And what was actually better was creating a whole bunch of good strategies and trading them all at the same time. That actually turns out to be a whole lot better, a whole lot easier than creating this one great master strategy. You know, I have people who I know who are traders who've been working for years on this great, you know, strategy. One guy I know has over 20,000 lines of code for one strategy. Problem is he's never been able to make money with it. Every time he goes live, he gets a couple losers and goes back and realizes he wants to tweak his code and to engineer out those losers, and it'll never work. So the way I go is just creating good strategies, not creating great strategies. Okay, so what if you're creating a trading system and this is it? This is your back test, which is pretty decent. But what happens a lot of times is this is what happens in real time. I'm sure it's probably happened to you. I know it's happened to me a lot, especially as I didn't know what I was doing. But back tests look great, real time falls apart. That's probably the biggest problem that I see people coming up with. Another problem is if you traded just one strategy, what happens if the market changes? So for example, in 2014, the euro started to hit record low volatility. Picked up towards the end of the year, but at the time I made this chart, it was probably like August, September type time frame. Record low volatility. So if your strategy depended on the euro, it probably depends on it being volatile. All of a sudden, you can't make money, and that's a big problem if you have one strategy, right? All of a sudden, your chances are just evaporating. So, if you really want to rely on one strategy, you do a lot of hoping. You got to hope that that strategy you're trading is great. You got to hope that when you developed it, you didn't cheat or do something wrong. And we just saw an example of that with that British pound system where the back test was great, but obviously something went wrong. And when you start real-time trading, it fell apart. So probably there was some mistake made there. You better hope the market doesn't change. If you're looking for volatility and you go to zero, you're in deep trouble. I mean, there's no other way around that, right? And obviously the other one is you better hope no one knows about it, because obviously if it's out in the public domain, chances are it's just going to get traded away. So a good example of that might be maybe the turtle trading system that worked good for a number of years, excuse me, worked good for a number of years, but now doesn't work as good. It still is decent, but everybody knows about it, and so a lot of people trading the same thing might actually trade away that advantage. You can probably get away with 10 or 20 people trading something with small size, but you start getting some of these hedge funds and CTAs involved in any kind of trading strategy, you're probably going to be in trouble. Okay, so you end up doing a lot of hoping. And then, if you look at trading as being a balance between hope and fear, it's way too much hoping for me. Trading one strategy, you're putting all your eggs in one basket, and it's just not good. So here's what I do. I trade what I would call good but not great strategies. And there's a lot to that. People have said to me, well, why don't you try trading great strategies? You're kind of being an idiot for just going for good. Well, there's a couple methods to my madness. One is coming up with a good trading strategy is a heck of a lot easier than coming up with a great one. I can probably come up with 10 good ones before most people could come up with one great one. And when I trade those together, which I'll show you in a second, you get a lot of benefit. The other part of it is a lot of people think that they have to keep improving the back test. So for example, last week somebody emailed me and they were talking about exits and wanted to know what exit's the best. And I tried this exit. I'm going to try this, 5 more exits, and I'm going to pick the best one, as long as it improves my back test curve. And my answer to them was, hey, don't fool yourself. Just creating a better back test doesn't mean it's a better strategy. And a lot of people don't get that. You can't rely on the back test for the future. It's that old hypothetical thing that I mentioned before. Backtest results are definitely hypothetical. So what I do, I trade a whole bunch of different strategies. So here's just some of them. You can see here's a gold strategy, here's a soybean, here's a coffee, there's a crude oil, there's another gold. Actually, this is a spread trade with gold and silver. There's a gold there. There's a mini Russell. There's a mini S&P. So I have a whole bunch of different strategies. I think I personally trade around 70, somewhere between 70 and 75 strategies right now. And none of them I would say could earn a living by themselves, but they all contribute a little bit. And if one of them underperforms, because people are always worried about strategies breaking, it's no big deal. If you're trading 100 strategies, every one should be 1% of your account, right? Allocated 1%. So if one breaks, that's not the end of the world. I just go and replace it. So the reason it works, because of trading diversification. So here's one strategy. Okay, so this is a pretty good strategy. A lot of people would like this. But what if you had traded this strategy and started it right here, and all of a sudden you hit the worst drawdown? Chances are you would have quit long before this probably $10,000 drawdown. This is all per contract, by the way. Even though if you had hung on, you would have done great. Diversification. Here's 10 strategies together. And you can see the drawdowns are less severe. Now, less severe probably percentage-wise of your account. Maybe you have over a $10,000 drawdown there, but you're trading 10 strategies, and you also have 10 times the amount of profit. So diversification is really the key. You're trading multiple strategies. They add together and give you something nicer than any one by itself. And you might say, well, how is that? I'm still trading them all. Well, my simple explanation for that is profits add, drawdowns don't. So think about it. If you're trading 5, 10 different strategies, one contract each, let's say, your profit is going to be the profit of 1 plus 2 plus 3 plus 4 plus 5 and so on, right? It's additive. The profits are additive. But the drawdowns, if the strategies are not correlated, meaning they don't go up and down at the same time, the drawdowns aren't going to add. What's going to happen is strategy 1 will have a new peak while strategy B or strategy 2 is in a drawdown, but they'll kind of even each other out. So the drawdowns don't add up, and that's why diversification works, and that's why I'm such a big fan of it. And the way I do it, I'll talk about later, but it's really what I call building your own strategy factory. It's a process to test and develop all your strategies and evaluate them. You take your trading ideas in the door, you work on them, and either they leave as strategies or most of the time they leave as scrap. They're no good. Most ideas are bad. It's funny. A lot of people think, hey, if I read it on an internet forum, it's got to be true, and this strategy's got to work. So they pull up a chart, look at a couple trades, and say, oh, yeah, it works. I'm going to start trading it. Well, that's not the way to do it. And when you do it that way, you're going to lose money, almost guaranteed. So you have to be really careful of how you develop strategies, and that's kind of what I teach. I'll talk about that later. But hopefully I've kind of set the foundation of why I'm going to talk about 7 different ways to trade the mini S&P. You could say, well, hey, I just need one way that works. Well, yeah, if you find one way that works and you have confidence that it's going to work 2 years, 5 years from now, go for it. And if it makes enough, go for it. I can't give you that, and I don't know anyone who can, to be honest. So what I do is I look for a handful of different ways to make money with the S&P or any other market, for example. I'll look different ways to do it, trade different methods. Some years things are going to work out good. Some years they're not so good. Give you an example. I give away, anybody who's on my email list, I give away a soybean strategy that I actually trade myself, my own money. This year it's probably around break even. So it's gone 7 months really without making any money. It was up a couple thousand per contract. Wasn't doing so good. But last year it there were a couple nice trends in soybeans that this caught, and it actually made like $29,000 per contract. So that is pretty awesome, but I don't expect that to happen every year. So what ends up happening, for example, this year, I have other strategies that are doing real well that maybe last year didn't do as well. So again, you never know which strategy is going to work best going forward. So if you trade a bunch of them and long term you know they're going to make money, I think you're a lot better off. So with that, what we're going to do is I'm going to go over a couple day trading approaches that you can use, a couple of swing trading approaches, and a couple of options trading approaches. So some of these are pretty well formed ideas and systems that you can kind of take and run with immediately. Some are more just ideas that you can test and evaluate yourself. But in any case, let's just take a look. All right, so approach number one. So I did some data analysis and went back and looked at the mini S&P from 1997 to 2010. And I'm not, I hate to break away just real quick, but a couple of people have been asking if I'm going to record this. This is being recorded, so you will get a link to it later. Okay, so took, what is that, 13 years of data roughly, and kind of look where the highs of the day and the lows of the day occur, okay? And what's kind of interesting here is that many times the high of the day occurs on the first 5-minute bar and the low of the day, and the market just trends from there. Other times it's at the end of the day where the high or low occurs. But if you were to look for the high of the day and low of the day in the first 30 minutes or the last 30 minutes, that's like 50% of your days. Now what's interesting about that, could you use this in your own system? Well, no, not just as is. You can't just say, you know, if the high of the day has occurred, then go and trade it. But you could use this as kind of a filter to say, hey, I think the high of the day is happening today. And what you could do is a couple things. You know, first, what I would do is probably verify it with more recent data. This is 5 years old, right? So I would want to look at the last 5 years and say, okay, is this kind of thing hold up where 50% of the time the high or low is hit? And then what you might want to do is combine it with some kind of candlestick pattern, maybe some kind of reversal bar or some kind of reversal formation that would suggest the high of the day was in or the low of the day, let's say at the beginning. That could be kind of useful. And if you thought it was in at the beginning or the end, you could assume, hey, this is going to be a trending day rather than some kind of ranging day, and you might get out at the close. You know, the other thing you could do too with this is you could use this for a little mini trend going into the close where the higher day is near the close, and so you just kind of take a breakout towards the end of the day. That's kind of an extra approach I'm not even talking about here, but just one that came to mind. And this chart is actually just broken down into 5 minutes. Maybe you could break it down into 10-minute segments or 15 or 30. You know, there's a lot of different ways to dissect the data to look at it, but again, all you're looking for is some tendencies of the market. Okay, well, the tendency might be the higher low day is hit early on in the day or late in the day. That could be useful. Here's an example. This is about the first half hour or so. You can see this reversal pin bar. You know, it looks like a thumbtack upside down. And, you know, maybe you have that and it's going down. That could be your signal that, hey, this could be a high of the day bar, you know. And you could say, okay, well, now I'm going short. And, you know, in this case, it would have worked out, but who knows? This is something you'd have to test. And again, you know, I'm not saying, hey, use this exactly. I'm just giving you an idea of something you could test and make part of what you're doing. And obviously, the testing and evaluation is a key part of anything that you do. You know, don't just see something and see a couple instances of it and go with it. You need more than that. You know, the other thing you could do is a lot of times there's these overnight gaps. And so I'm looking at the ES system that just happens during stock market hours. So, you know, I know the ES runs practically 24 hours a day, but you could take the data and just apply stock market hours to it, which is 9:30 to 4:15. Well, the futures go to 4:15, the market goes to 4 o'clock. So maybe you say, hey, I'm going to look at gaps, and I'm going to assume that gaps are filled. That leads you to the second approach, where you can see these particular days, the market closed here, and then by the next morning it had gapped up to here. This is where it opened. And then this day it closed here, and it actually gapped up again and went down. And the same thing here. So these blue lines are actually gaps that are all filled. So maybe what you do is you play a gaps are filled type approach. And again, it's something you'd have to test, but it's something that could work out pretty well. And what I've done is I actually have a trading system that kind of incorporates both of those. Takes both those concepts. And I don't want to say I use it exactly because I don't, but it was kind of where I went with what I was doing. And this is actually a trading system I actually trade live. And hey, it's done pretty well for a number of years, going back to 1997. So one drawback to it is, well, look at 2015. It's only made $1,000, and you can't even see that here. But you know, I checked it on Friday. It made like $1,000. Actually, this is back from January. So this year, I think it's gone down and then come back up. So it's about even, and that's in 7 months. And so again, you know, I was saying earlier, you can't rely on one strategy. This is a pretty good strategy long term. You know, this is one contract over, what, 18 years, made $130,000. So that's what, like, I don't know, what's the math on that? $7,000 per year average return per contract. That's pretty good. Most people would really kill for that. But it's also pretty variable. You know, you got these flat periods and drawdown periods. And again, that's my point. If you're trading a bunch of different methods, you're a lot better off because it kind of evens out. So this would actually be could actually be a third approach, where I take the idea from one. The idea from one, you could create its own system. The idea from two, you could create a strategy, or you could combine them, create a third one. Pretty cool. All right. So let's move on. Those are day trading. Those are always harder to come up with, by the way, in case you're developing your own strategies. Much, much harder to come up with day trading strategies. Swing trading is a lot easier. And you might say, well, why is that? And two, I don't like it. Well, one, the reason I think it occurs is because the market wants to encourage people to hold overnight, to take that risk. You know, there's people who want to get rid of risk overnight, so that means the market's going to pay people to take on that risk. That's the way I look at it. And two, you know, you might not like it, but if history shows it's good, that might be a better way to trade than intraday. I know a lot of people are hooked on intraday trading, but you know, there's not a lot of successful intraday traders out there, especially automated, unless you're running some kind of scalping strategy for a high-frequency hedge fund. You know, that's about it. Okay, so I look more at swing trading strategies. What are those? Those last a day, 2 days, maybe a week. You know, it all depends how you set it up. Here's an example, and you can actually just, this is Tradestation code, at least the first 2 lines. you can program this in Tradestation with daily bars, and you'll get pretty nice looking equity curve, even after slippage and commission. But all you're doing is just doing some mean reverting here. If the close is less than the average 5-bar close, you buy. And if it's greater than the average 5-bar close, you sell short. And then no matter what, you're exiting after 5 bars. Now, obviously, the drawbacks to it, there's no stop loss. But the 5-bar, is that best? I don't know. I didn't optimize. I just picked it out of thin air. I said, hey, a week, compared the daily average to the last week average. That's where the 5 came from. This is all daily bar based. And who knows, it might work on some other time frames. I've never tried it, but and this is what it does. If you look at your moving average, you're going short when it's above and you're buying when it's below. So it just mean reverting, because normally when you have a breakout above a moving average, you usually want to go long, right? I mean, that's a traditional trend following moving average approach. But the ES and stock market indices don't tend to work like that. They tend to be more mean reverting. So this particular system works really well for the stock market because it does have this mean reversion. So here's the results. You can do this yourself and probably pull up something, should be something similar. I have over 750 trades and $89,000 in net profit. And this is after, I forget how much, probably around $20 slippage and commission. So that's not too bad. The last couple of years haven't been as good, I don't think, because of the stock market just kind of going up. The moving average is just a 5-bar, just a simple moving average. So it's really simple. And, people are amazed that something like this could even work. But my philosophy is a lot of times the simpler things are more likely to work. When you start getting too complicated with your trading systems, when you have, 10 rules, 10 filters, all this other stuff, you're going to get in trouble because you're just curve fitting. You're putting too much to the back test. You're trying to make the back test look too good. And I don't recommend doing that. So I try to keep things simple. Hey, this is about as simple as you can get. One thing for buying, the exact opposite for selling, and then you just exit after 5 bars. That's pretty simple. Okay. But like I said, maybe a snazzier exit would work better. I'm sure it would. But take a look at that last point. Be careful of curve fitting. That's, there was an article, I think you can go online to Modern Trader, which was Futures Magazine, and I'm not sure if this article came out yet or not, but I wrote an article that was basically says, don't try to make a better back test, because when you do, you end up getting in trouble. And that's a key thing here. You have to ask yourself, is this good enough by itself, or do I need to enhance it? But a lot of people want to keep enhancing, especially more analytical people like engineers and that kind of those kind of people, because you want the numbers to look better. And trust me, sometimes making the numbers look better actually makes it look worse. It's weird, but that's how it works. Okay, here's another mean reverting strategy. And this, I'm not giving you the actual numbers because I actually trade this one myself. And this is the performance. These are daily bars, the last 1, 2, 3, 4, 6 months. And you can see every single trade except the one on the far left has been a winner. But every trade has had significant draw, a good drawdown against it. So it's not like this is perfectly timing the market kind of thing, because certainly if I was to draw where I'd want to enter and exit trades, it wouldn't be this system, right? But the point is, over time, it's still cranking out a profit, and it's been doing real well this year. And it's a mean reverting strategy, sort of similar, but instead of using a moving average, this is using the highest close and lowest close. So normally people think of, well, hey, the highest close, I'm going to buy because it's breaking out. Well, with a mean reverting market like the stock market, that's usually a good time to go short. And then the time to buy is when you have this lowest close. And so that's what I'm doing here. And there's a couple other things in there. This one I actually do have a stop loss, and I have a little filter for volume to make sure there's enough volume or not too much volume, I forget. But the point is this could be a good start for something you could take and kind of go and use on your own. Here's what it's done over the history of the mini S&P. It's done really well, and you can see this year it's just been off the charts. Every trade's been a new equity high, but look at this flat period. Look at this barely doing anything, and all of a sudden it jumps up, and you know, here's a nice drawdown. So even with this, you know, a lot of people would look at this and say, oh, this is a great strategy. You know, I wouldn't do this, but I bet I could go and sell this and just show this screenshot, and people would be like, oh, this is the holy grail. Look, it never loses. Well, except for that one, but you know, 9 out of 10 it wins. Wow. That's how you can be fooled. So yeah, this is a good strategy, but it is not great by any means. I mean, think about if you started trading right here, you'd have to go, what, almost a couple hundred trades before you really made any money. Could you do that if you were just trading this system? Not at all. You would give up long before. You'd probably give up here, and if you didn't, when it came back down after it went back up, you'd probably give up here. You know, and certainly you'd probably give up after this drawdown. Almost nobody would keep going until where you are today. But, and here's the big, I guess, paradox. You trade this with other systems. Okay, well, hey, there's other systems you probably will have that'll probably be doing good in this period. Maybe other markets, maybe other kinds of ES systems. I don't know. They'll be doing good and they'll make up for this. And so then you can carry this system through this, because you know every once in a while you get this kind of performance or this kind of performance. So this year, you know, if I look at all my systems I'm trading, I can pretty much guarantee you this ES system is holding its own weight and then some. It's contributing more to the bottom line, and it's probably holding up some systems that are just kind of break even. So, all right, so that's swing trading approach number 2. And again, I trade that with my own money. So here's some, I'll give you a couple option strategies. Now, the problem with option strategies is I have found they're very hard to test accurately. And the reason is because a lot of times even if there's a bid and ask price, to get any kind of volume, you're going to be moving the bid and ask. A lot of times the settlement price, you can't even trade at that. A lot of things just don't have enough volume. So these are really tough to test. So if you're going to go this route, be very careful of testing. And what I did with a method I've used for the last couple of years, what I do is I actually just went live and I started trading one contract, which, you know, is ridiculously small. I was selling one ES contract that was like for $50 premium, you know, but I wanted to build my approach and kind of develop my rules, and eventually I got to the point now where I'm doing it with a much bigger size. But I kind of did a live back test, and which actually is better than any other kind of test, right? Because it's real money. So why might you want to use options? Well, let's just say you're dealing with some non-trending markets. Selling options, for example, could take advantage of that, and you might be able to get some premium. So for example, this year, just in talking to a bunch of traders, it seems like the option sellers are the ones who are doing the best, where trend followers aren't doing as well. They might still be having a positive year. I look at my own trading and my trend following is positive, but my option selling might be doing a little bit better. And a lot of people, I think, are like that, where maybe 2014, the reverse was true. Okay, so, the way to look at it, futures markets, you want directional trading. You want trends up, trends down. But options, hey, if it's going to be in a flat range, you want that. And even the S&P, yeah, it's kind of been going up, but it's not these violent trends, and this might be a good time for some option strategies. So one thing you could do is just sell options, sell them naked. And what I did in this example is I actually sold a call above the market, sold a put below the market. And so as long as it expires between these two values, I make a little bit of money. Okay, and actually it's $425. But you can barely see that on this graph, because if the price goes way up or way down and I don't get out, I could lose a ton of money. And that's the drawback to option selling. And that's why most people shy away from it, especially the naked option selling. A lot of brokerages won't even allow it, because if you don't know what you're doing, you could really get yourself killed. And I guess it only takes one time to get killed, and it'll take you years to get that back. So you have to be careful. But with this kind of approach, I could actually get, if I kept doing this over and over again, with some margin cushion, a 44% annual return. That's pretty good if you can do that. Some people might want a little more cushion, so they give up some return. But of course, you're always on the edge of that cliff, where if the market goes way up or the market goes way down, you're in trouble. So for most people, that won't even be something you want to do. What you probably want to do is something more like this, where you're buying and selling options. So in this case, I sold the same two options I sold before, high price call, low price put, but then I also bought a slightly higher price call and a slightly lower price put. I collect a lot less money, but I don't need much margin for this, because my gain is capped at, in this case, $78 for this whole trade. But the most I can lose, no matter what happens, is $400 some. So $430 actually. Now, is that worth it? Well, if you were successful in this and kept repeating it, 3 or 4 times a year, you could get 67% return. That's pretty. Most people would kill for that, right? And your loss is capped. The bad part about this one is, it always seems like the first time you go into a trade is when you'd hit that loser right off the bat. It'd be a lot nicer if you hit 10 of these and then hit a loser, because you'd still be up overall. But most people, myself included, the way it seems to go is you lose right off the bat, and then you have to scramble to gain it back. But it's just another technique. It's better risk management, and actually turns out to be a better return. Now, that isn't always the case, but you'd have to play around with it. But that could be kind of a nice type strategy for both of those are for when the markets are flat. If the markets are getting volatile, you're going to get into some trouble, and if they start moving a lot, they're going to get in trouble. Okay, so and especially the S&P options, because there's so many of them, and there's a lot of volume in them. You can pretty much do whatever you want. I mean, you can do synthetic long positions. You can be long. You can buy calls, all sorts of things, and limit your risk. And at the end of the day, that's what it's all about. Some people like to look only at the money part, but really it's that risk adjusted return. So you got to factor in drawdown into anything you analyze. And you might get better leverage than you do with the futures. That's why people use it. But the downside, if you use it incorrectly, it's very dangerous. They always say there's a lot of old option sellers, there's a lot of bold option sellers, but there's not a lot of old and bold option sellers. It seems like the people who really take chances with selling options get wiped out. So that's why you want to watch out for option selling. But it can be part of what you do. So in my own trading, this option selling is a part of what I do. And if it has a bad year, gets wiped out or whatever, it's not going to kill me. So for example, I was selling natural gas calls back in 2014 when there was this big freeze. It was a terrible winter, and it hammered me, but it didn't wipe me out because I had so much other stuff. So it was a small part of my portfolio. And again, that kind of goes back to the whole you want to be diversified. Okay, well, option trading, does it work for the pros? Here's one. This fund, very nice equity curve. It's only up 6% a year, but hey, when it never goes down, back to 2009 was the last time it had any kind of significant drawdown. That's pretty nice. And so this guy does mostly, you can see, option spreading. So he's buying and selling options and trying to reduce his risk, but he's doing it all in the stock indices. 139 million in assets, so he's doing pretty good. So the pros use it. But again, it's all about risk management. Okay, so what have we talked about today? Day trading. Look for the high and low of the day and do some analysis. Maybe look at gap filling, where those gaps are going to be filled. And you can do a combination of those. And there's obviously a whole bunch of different variations of that you can do. Swing trading, I happen to give you two that are mean reverting. One of them I'm trading myself, but they're pretty good concepts that you can kind of take and build your own system. And then when you start to get to the flat markets, take a look at maybe doing some option selling. Just protect yourself on the downside, but that might be something you want to look at too. So, the question is, well, hey, why do you need so many strategies? Like I said, in 2014, I think trend following worked better, but 2015, option sellers are doing better. You just never know year to year what's going to be good and what's not going to be good. What markets are going to trend, what aren't, what's going to be high volatility, what's low. You just don't know. And if you have multiple strategies, chances are every year you're going to have something that will work good. So the way I always look at it, let's say I have 10 strategies. I kind of plan on, in any year, maybe 2 or 3 of them will lose money. Maybe one I'll have to retire. And then 4 or 5 will kind of be around break even, maybe make a little, maybe lose a little. But then the rest of them, 2 or 3 the last 2 or 3 will make a lot of money. And they'll pull the whole portfolio return up. And that's obviously why I have them. But the problem is, I don't know if I'm going to have them the next year or not. You never know what's going to happen year to year. So that's why I do what I do, and that's trade multiple strategies. And the key to doing that, though, is you got to have a solid method in the first place to develop them. If you don't have a solid method, you're going to be in deep trouble. Just creating strategies using a traditional backtest is just going to get you into trouble. Kind of like that chart. A lot of people will see something like that, develop something like that, and think, hey, I just create a great strategy, I'm going to go trade it. And I can guarantee those kind of strategies usually lose because they're just way over optimized. So what I've done is I've kind of distilled everything I've learned over the years, and I put this all together in what I call a strategy factory, where you have ideas, your trading ideas come in the door, right? And then inside this factory, you put all these little machines to work that do your testing, do your walk forward, do your random Monte Carlo simulation, do your incubation. And what comes out is either a trading system that you can go and trade, or something for the scrap heap. something that just doesn't, you know, doesn't work. That's where most of it is. But you know, if it was any other way, then you'd wonder, how's it so easy to develop trading systems? Well, it's not, but it can be done. It definitely can be done. So that's what I run. In case you're wondering, can it really be done by people besides me? I'm going to type a link in the chat box, and you can click on that, and that'll show you some of the strategies that students have created, which is pretty neat to see. They've created those, and seem to work pretty well for them so far. This is the process I use, so feel free to take a screenshot of this. You'll get a copy of the recording. So, you know, I go from goals all the way through your idea, through your testing, until you do real money operation. And that's really it. But obviously the devil's in the details here. But this is what I teach. What I teach you in this workshop is strategies how I create strategies that work, and to do it the right way, because too many people do it the wrong way. But let you begin creating your own strategies. So the great thing about this is you don't have to rely on somebody else to develop strategies for you. You don't have to worry about what they were doing. Did they curve fit this? Did they use too many rules? No, you don't have to worry about this anymore, because you're doing it yourself. And when you do it yourself, in the long run, you're going to be better off, as long as you know how to do it right. And that's kind of what I teach. And this is a full day class that I teach. It's called the Strategy Factory Webinar, Strategy Factory Workshop. Full day, it's live, it's online. You know, it has a limited number of students, so not like today where, you know, we've got over 100 people here, and you know, I can't really get to your questions until the end. With this, hey, you can ask questions, and I'd be able to answer them as they come up. It's really nice. And then we talk one-on-one before and after the workshop for 30 minutes in total. And then I give probably the best thing, the email support, where I answer all your email questions. No one else does. It's just me. And so sometimes it takes me a few hours to get back to you, but I help you. I get you to the point where you can create strategy. So for example, one former student, I counted, it was 132 questions he sent me, 132 emails. Some of them had multiple questions. From the time he took the class to the time he created a strategy that worked, but he did. So it was all worth it in the end. I also give you a couple strategies to trade that I trade myself, which have done pretty well. And that's just kind of like a bonus. And actually, this is how well they've done during the past year. So, you know, I've been putting on this workshop for about a year. If you had started trading them at the beginning of when I started to do it, that's kind of where you'd be, just trading one unit. So it's done pretty good, but I don't want to say it's like extraordinary. You know, a lot of people would look at it and say, well, hey, you had 4 months of nothing performance. What's the deal with that? That's what happens, and then it just kind of takes off. So, but anyways, I give you these strategies. Like I said, I trade them myself. So here's some strategies that students have created. They're all decent. Nothing's great where I'd say, wow, this is the holy grail. But you add these together, trade them together in the same portfolio, you're going to do pretty good. So, okay. If you go to the website, there's a website called, it seems to be down today, but a website, tradingschools.org. I have the only product ever reviewed there that has all 5 stars. There was one that came close, which is Top Step Trader, which is a pretty good group, but they had like 4.7 stars. But most of the places this guy reviews gets 1 or 2 stars, so that should tell you something. And there's 3 dates open. There's only 2 spots left. I have one next Wednesday, and the price is going up in September. So if this is something you think you might want to do, and you know, if you're a beginner trader, don't even sign up, because it'll probably be way over your head. But if you're kind of intermediate, you've done a little dabbling in strategy development, this might work out really well for you. It's a lot of money, so I don't want to say it's not, but I think it'd be well worth it. You know, if you think of all the money you've probably blown trading systems that were bad or developing systems the wrong way, this is probably a small price to pay. You'll probably recoup it pretty quickly. So there's 2 spots left. You can go to the link I just gave you, and we can go with it. All right, so with that, I think I have the book giveaway now. And so what I want to do is let's go to this. So what I'm going to do is I'll take your questions in a minute, but right now I want to give an autographed copy of my book to the 3rd correct answer to this. So I might have just given away the answer. Okay, just give me one reason why you want to trade multiple strategies. Okay, it looks like looks like Kurt is the winner. And thank you. There's probably about 10 or 15 people that, well, about 20 people now that have answered something correctly. But Kurt is the winner, and so I'll be getting in contact with you afterwards. Some of the answers: strategies fail, diversification smooths the equity curve, better chance of success, you never know what's going to work in the future. There's a lot of reasons to build multiple strategies and trade them. And that's kind of the point I hopefully was driving home today. So with that, what I'll do is I'll start going through questions. If you have questions, type them in now. And if I apologize in advance if I miss them and step over them. Feel free to email me afterwards, kdavey@kjtradingsystems.com. Anyone who knows me will tell you I'm really good at answering questions. You know, I'm trading during the day, but a lot of what I'm doing is just automated. And so I'm just kind of babysitting, and I'm doing a lot of other stuff, a lot of other strategy development. So I always have time for emails. So with that, I'll stop chattering and start looking at your questions. Okay, as I mentioned, it is being recorded. Okay, Doug's asking, do backtesting results have different fills than live? Yes, they do, Doug. And depending how you backtest, you could get dramatically different results, to the point where I wouldn't believe it. So for example, if you're trying to do some kind of scalping approach, you probably cannot rely on the backtest at all. And some of it's the way the backtest engines are set up for all the software, whether it's Ninja, Multicharts, Tradestation. And some of it is just some of the assumptions that you make. So what I've found, and one of the keys to making backtesting work, is you got to know what is realistic. And that's part of what I help teach, is I make sure the students, they send me, hey, I'm thinking of this, and I'll tell them, well, that might not work. So for example, somebody sent me a system with a bunch of stop entries, and I said, well, this backtest's good, but the problem is in live trading, a lot of times these particular stop orders will be rejected by the exchange. So your backtest will look good, but real life, you're going to get rejected orders. So it's something you got to know about and watch out for. Okay, the gaps are LB is left, but he was asking about the gaps are filled approach. And that's just where you have a gap and you assume that the next day it's going to be filled by the market. The market's going to retrace back down to the gap. Okay, I think I actually answered Sam's question and Wayne's question. Okay, Francisco's asking, scale in and scale out in mean reversion It's considered optimizing even if done later on in system testing. You know, one of the things I try to avoid is any kind of testing where you scale in and scale out, especially when it means you're adding to losers, because that can be a very dangerous proposition. The one system I do give everybody in the workshop actually adds to a winning trade, but it'll never add to losing. So any kind of scaling in, you have to be really careful about, because that can come and bite you. And it can always be a lot worse than you ever expect. You know, a lot of people say, well, hey, I've never had more than, gone down more than 5 levels of scaling in. Well, you know, as soon as you trade it, you're going to hit 7 levels. That's just the way it goes. I know a lot of trading rooms get blown out by trying to catch that falling knife type thing. Okay, Sam is asking, are these strategies fully automated or human driven? Good question. What I always recommend is, as much as you can, you want them to be automated. You want them to be rule based. You want to take out as much of your decision making as possible. So a lot of what I do is 100% mechanical systems. I just follow the rules. And when you're trading 50, 60, even 10 systems at the same time, it's really hard to use your discretion and add that to it. It's much better just to trade it the way it was designed. So for example, I just got an email over the weekend from somebody who was saying, hey, I've got a system and it back tests pretty good, but I'm thinking I could do better in real time. Is that a good approach? Where maybe I move my stops from what the system says because I think there's momentum and the market's going to keep going. And my answer was, once you start monkeying around with what you've tested, you start to get into trouble. You start to invalidate all those results. And so you don't know what you have. Do you have a profitable long-term system? I don't know. So I always avoid that. The more you can do automated systems, I think the better off you are. Okay, so Manuela is asking, how do you know when a strategy is broken if you trade it for 2 or 5 years already? What I do is I have some certain criteria, and we actually go over this in the workshop, where you come up with some criteria before you start trading it, and then if that criteria is ever hit, you turn the system off. And there's no magic number or magic performance metric that always works. And in fact, what I do in some of my tradings, I use different metrics for different systems. Some of it's pretty much almost random, but I always know when I'm going to quit every system I'm trading, and I stick to it. Because what you want to do is you don't want that system to bleed you dry. Yeah, it loses money, but that I can live with. What I can't live with if that one, is bleeding and I let it bleed until I'm out of blood, kind of thing. You know what I mean? So yeah, there are ways to do that, and there is a process I use to help determine that I teach. And the simple answer is just come up with something, some criteria, and just stick to it. Okay. Okay, so let's see. Lewis is asking, what trading platform do I use? I use Tradestation. I've used it for years. I've also played around a little bit with Ninja. I just like Tradestation more, maybe because I learned on that. Easy Language is pretty easy. That's why they call it Easy Language, right? They also have what's called a .NET version, or object-oriented. But I stick with Easy Language because the way it was described to me is Easy Language was written by traders for traders, where some of the newer stuff in Tradestation and the other languages were written by programmers for programmers. And I don't want to learn to program. I want to learn to trade. So you saw some of the code, some of the Tradestation code there. It's pretty simple. That's what I use, and I'm pretty happy with them. They also have a brokerage, and most of my stuff I run through them. You don't have to though, but seems to work out pretty good. Okay, so Kurt's asking uh, when to turn off a strategy, and hopefully I kind of answered that. George is, hey George, how you doing? I know George. What is the minimum number of strategies one should trade to have decent diversification? You know, there probably is no magic number. Kind of what I've been finding in my own trading is I thought when I had 10 that was enough, but then I find that 20 is even better. And now I'm up around 70. I'm probably going to stop at somewhere between maybe 100, 150, and then I'll focus more on increasing size. But then once the size gets enough, I'll probably go back to adding more. It really depends on the systems, but I would say even if you have one or two, well, obviously one, you have no diversification, but even if you have two systems, if they mesh pretty well, you could get some decent diversification just from that. And then you just go from there. And it's, for most of us, myself included, it was kind of a slow building process where, I couldn't come out of the gate. I started out with like maybe I think a $5,000 account. I couldn't come out of the gate trading 10 strategies, but I could trade one. And as it started to do good, I was able to get money from other places and then build up, then trade 2, and then 3, and then 4. And that's kind of the way I approached it. And you can get by. Tell you what, people think you have to increase your size. Oh yeah, I got to be trading a 10 lot or I'm meaningless. I'll tell you what, you can get by a long time with trading 1 lots. And in fact, every new strategy I roll out, I start with 1 lots. And as they start to get profitable, then I start building up the size. So I'm making the strategy prove itself. And that's sort of part of the process I use here. I'm always leery that a strategy is going to fail. So I always want to trade small size. And I think you can get by a long time doing that. All right, Mike's asking, are you spread trading with futures? Yeah, I do. If you email me, I'll tell you I don't want to do a commercial for the group, but there's a service out there that does some spread trades. It's one of the few things I do that don't use this factory process that I use, but I've also been trading it long enough that I have enough confidence in it. So these are just calendar type spreads, some intra-market spreads. And again, why do I do that? Well, it's something different than normal trend following, single futures. When you're spread trading, you don't care that soybeans goes up. What you care is that 2 different months of soybeans act differently, and you make your money from the difference, not exactly the overall trend. So it's something different. Okay, Jan's asking, during the factory workshop, do we learn how to systematically find trading setups? This means how to be creative without curve fitting. Yeah, Jan, that's a good question. A lot of people ask, say, oh man, I'm not creative enough. I can't come up with ideas. And my goal at that workshop is to give you enough sources of ideas and enough food for thought that you never run out of ideas. If I look at my own log of ideas, I probably have 100 ideas, and I know most of those I'll never test. I come up with them all sorts of different ways, which I kind of explain. But the key is, if you're running a factory, what do you need? You need raw material, right? No matter what you're making. Ideas, your trading ideas are your raw material. And so I spend a bunch of time during the workshop explaining where to get ideas and how to make sure you keep a full till of them. Okay, is it best to wait with trading until you have about 10 or more strategies? From Gerard. That is a really good question, and you might be the only one ever to ask something like that, Gerard, because most people want to start trading as soon as they have one strategy. And there's a lot of wisdom in this, because Gerard's saying, hey, I want 10 for diversification, but it also implies that he has enough capital to trade 10. And those are two really important things. I'll just mention real quick. Okay, so if you trade 10, you get diversification, right? So that's good. That's what you want. You don't have to rely on one system. You know, like I just said, I was relying on one system for a while. That's kind of tough because it goes up and down, and you know, if it goes down, 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 you're in trouble. That's part of it. The other part is you can look at your risk of ruin versus what account size you start with, and I guarantee you the people with smaller accounts are getting blown out a lot more than the people with bigger accounts. It's just the nature of the game. And you know, you think about all these brokerages and forex dealers. You know, they're saying, "Hey, you can open an account with $1,000." You know, they're not thinking real long term. They just want to get a hold of your initial money, maybe get you hooked. But most of those people who start out with a little money get wiped out. So, you know, is 10 the magic number for strategies? You know, I'll tell you what, if I was to start over again, I would probably want to be starting with at least 5 strategies before I really went live. And if I had enough capital to start with 10, you know, if I was a brand new trader, I would definitely start with that then. And if I had my choice between 5 at 2 lots each or 10 at 1 lot, I would go the 10 with 1 lot. That's the way I would approach it. But the key to that is you got to have strategies that, you know, have a good history and that were actually developed correctly, because, you know, these aren't strategies you'd find on the internet that somebody's selling, because those are kind of dangerous. Most of those, especially the, you know, ones that the better they look, the worse they are. Mikel, hopefully I pronounced your name right. When you trade multiple good strategies instead of 1 or 2 perfect strategies, what's your definition of a good strategy? When is good good enough? Well, my definition and what I kind of teach, and I think this is in my book too, but it's definitely in the workshop. If you can get over a long period of time a return to drawdown of 2 to 1, that's a good strategy. So for example, let's say over time, trading one contract, you know, don't talk about compounding or anything, your strategy makes 40% a year. Well, then your max drawdown should be about 20% on average. Now, obviously, it could be more, it could be less, but if you have that 2 to 1 ratio, that's usually indicative of what I would consider a good strategy. You know, if you have one that's 1 to 1, if you get 20% return with a 20% drawdown, you might be risking too much. Flip side, if you find a system out there that's 50 to 1, where it's a 50% annual return and 1% drawdown, I would not even say that's a perfect system. I would say that's a bogus system. I don't think those exist. So 2 to 1 seems to be what I'm looking for. Okay. Thomas is saying, and you know, just keep the questions coming. I'll stay for as long as you guys want. As you can tell, I enjoy talking, trading. Thomas is asking, I'm surprised to hear you trade that many systems. What percentage of those are intraday versus crossing sessions? Probably out of those 70, less than 5, maybe 5 to 10 are intraday, if that. I actually want more intraday, but those are hard to come up with, especially over a long period of time. The swing systems seem to be, you know, ones lasting a few days, a few weeks. I even have some systems that last up to months. You know, they're longer term trend following. It's just kind of a big mix. But, you know, once you have it all set up and you're doing it automated, you know, not everything I do is automated. You know, like my option strategies, I do those manually. But the more you do automated, then it's just a matter of, I don't want to say babysitting, but just monitoring, making sure your positions match, making sure you don't have to roll over. And, you know, there's a lot of other issues in there, but it could certainly be done. I have a friend in New Zealand who does probably 100, I think he said 125 systems last time I talked to him. I think he's all automated, and he doesn't do a whole lot of work during the day other than just kind of monitor his systems. Okay, Craig. Hey, Craig. What is your opinion of stops? Do you use them? Yeah, I almost always use them. There's a few systems where I don't, where it's just kind of like a stop and reverse. But the thing is, you just have to be careful that they're not too close. You know, you want them wide enough to give your position room to grow. The one thing I've never really found much benefit with is break-even stops. I know a lot of people love those, especially discretionary traders, because you know they say, "Oh, as soon as I can move to break-even, that's a risk-free trade." Well, the reality is when you go and test those kind of things, most of the time, break-even strategies in the long run just take away your profit and make your drawdown worse. Um, they're not as good as people think. Even trailing stops. Uh, More of my systems do not have trailing stops than have them, a lot more. I tend to put in a stop, let's just say it's like $1,500 per contract or whatever, and then just go with it and never change it. And that, in the long run, tends to work better. And you know, a lot of people get hung up on what looks good in the short term, and you know, those trades that go for you, and then you give away all your profit, and they get mad. That's just part of the game. You know, the market's goal is to trick you and make you feel inadequate and make you feel unintelligent and make you do things that in the long run aren't your best things to do. And I think like break-even stops fall in that category. Okay, Jan, another question. Do I have to be a programmer to join your workshop? I have some experience with TradeSense from Trade Navigator. No, you don't have to be a programmer, but you should at least know uh, whatever platform you're going to use, how to program some simple strategies. So for example, if I told you, hey, give me a moving average crossover system with a stop loss, if it's going to take you 10 hours to do that, then you probably need to know your software a little bit better. But if you could whip that out in a half hour or even less, then you probably got enough. You know, the one thing, if you decide you want to take the class, but afterwards you realize, ooh, I got to really learn Tradestation better. What a few people have done is I actually delay the start of the support until they learn it better. So a couple people have said, well, hey, I took your class in August, but let's start your email support in January of next year. And you know, I'm more than willing to work with you on that. That's not a big deal. Francisco's saying, are your strategies symmetrical? Are you okay with the rule for long and another for short, or maybe different parameters? Excellent question. I tend to like symmetrical ones, but I'm not like 100% saying that's the way it's got to be. The problem with doing what you're saying, Francisco, is now instead of one rule, let's say for your entries, or one parameter, maybe it's a moving average you're going to optimize. Now you've got one for long and short, so now you've doubled the amount of parameters. And what I like to avoid is having a lot of parameters. You know, if you have 10 or 15 parameters, you're going to be in trouble. But if you have 4 to 6 parameters, you probably will be okay. So I like to do that. The other thing I like to do is I like to see roughly the same number of trades on the short and long side, but I'm not, you know, it's not a requirement. But what is a requirement, I think, is you want to have both the ability to go long and short. So, for example, you don't want a system that can only go long. I think those are to be avoided, and I feel pretty strongly about that. Okay. What kind of software? Dirk is asking, what kind of software do I use for backtesting? Right now, all I use is Tradestation, and then to do the walk forward analysis, I use a third-party tool because I don't like Tradestation's walk forward. Lewis is asking about Metastock. Is that something we should use? I've never used it. The key, what I tell people, as long as it can do an accurate back test, and as long as it can do some kind of walk forward testing, then you're okay. You should be okay. The other key is you want to get to the point where you can create really good looking systems with your software that you know are fake. And you might say, well, why would I want to do that? Well, knowing how the ways around your software to create unrealistic results is part of mastering the software. And when you can do that, that tells you and tells me that, hey, I know how to create systems because I also know now how not to, how to fake out my back test engine, whatever software it is. And, every software has it. I think that one curve I showed earlier, let me go back. Where is it? This one, actually. This is one I created in Tradestation in literally less than 5 minutes. And it will never work. And I know that, but that's what you should use. So I don't know if any students so far have used Metastock. I know they've used Tradestation, Multi-Charts, OmniBroker, Trading Blocks, a couple other things, but you might be able to use it. Okay, Greg is asking, what is recommended capital requirements for trade automated strategies? One may have goal to implement live, but if fewer than 50,000, where does one start and build confidence trading live? It's really hard to give you an exact number, Greg, just because so much of it depends on the systems that you create and use. But if you have limited funds, what I always tell people is, well, and you think you want to trade long term. Well, now's a good time to start building strategies, and then at the same time, work on getting more capital. And don't go live on right after you take a class or something with only $5,000 in your account and trading one strategy, because that probably won't work. It might. It's just tough. Trust me, that's kind of what I did. But what you can do is if you start creating strategies today and you don't even have the ability to trade them for a while, that's actually a good thing. Why? Because one of the big things people always do with trading strategies is they overfit too many rules, and they create that back test that I showed you earlier. Just to remind you, I'll go back to it. This kind of thing, where they create a back test that looks like this, and then it falls apart in real time, or goes, this isn't really falling apart, this is just not performing well. But if you created strategies today and just let them run, even if you're not trading them, you could see this real time, and that's a great feedback that, hey, I'm doing things correctly, or I'm not. I got to do something different. So that's kind of the way I'd approach it. Lewis is asking, is there much in the seminar that isn't in your book that I bought already? Well, hey, thanks for buying the book, and hopefully you liked it. Obviously you liked it enough to attend this webinar, because I haven't seen comments from you saying, hey, the book was awful. But there is. I mean, the book goes through a lot of the steps in the factory, but what you get out of the workshop is a couple things. One is obviously that there's a lot more detail, and there's a lot of other things that I add in there. Two, you get the email support from me, which a lot of people have told me is the best thing of all. So, you send me a little snippet or a report and say, hey, what do you think about this? What should I do? Or, I'm frustrated, I haven't come up with anything. That's another thing you get. Another thing is I have this, what I call, it's called a Strategy Factory Club, which there's a video on my website about it. But basically what it is other students will share strategies. And they'll share strategies only after their performance has been proven in real time. Well, how does that happen? Actually, what everybody does is they give me the strategies, I maintain them, I report on the results once a month, and then after 6 months, all the strategies that meet certain performance goals are shared amongst all the people who submitted passing strategies. So, you might say, how am I going to create enough strategies to really be diversified? This is one way to do it. So last month, for example, 7 people created strategies. Let's say you were one of those people and 5 of them 6 months from now pass. Well, you'd get a copy of the 4 other ones that pass besides yours, and then I always throw in an extra strategy that I created and I trade. So right there you get 5 strategies plus your original. You have 6 strategies now that all have at least 6 months of real-time performance under its belt, which is pretty cool. So there are things in the workshop that go way above and beyond. And then the last thing obviously are those 3 strategies that I give you. And if you decide to trade those, you see how well that did the other day, or in the past year, I should say. Okay, couple more questions, and then we'll kind of wrap it up. Francisco's asking, do I have a favorite filter for bull and bear? Most people use a simple 200-day moving average. I've heard there are better ones out there. There probably are. I can tell you a lot of people, and I've still used it. I still use it, I think, in a couple things, 200-day. It's hard to say that there's one thing that always works better, because when I find it works better with one particular system, it won't work with another. The biggest thing I always tell people is, hey, you could come up with some crazy idea, but you're going to test it and evaluate it, and that's going to be the ultimate proof. And that will really tell you what's going on. Okay, George has another question. On your swing trades, how many trades a month or year would you expect? It really depends on the system, but generally, I have some that are maybe 10 to 20, some that are around 50 to 100 trades per year. It all depends on what the strategy does. The soybean strategy I give away, if you're on my email list, I think that only has like 4 or 5 trades a year, which is crazy when you think about it, but it's held up, and it's held up really well. So there's really no definitive answer. I would personally like to have, if I had my ideal swing trade system, I would say 1 a week, so about 50 trades a year. That would be cool, because then if you test it back 5 to 10 years, you have 250 to 500 trades, and that's pretty nice. How about strategies that enter in one time frame and exit in another? Sam's asking. I don't particularly do that, but you certainly could. I'm just trying to think of the mechanism to actually do that the right way and be able to test it. You got to be careful with some of these things where you can't necessarily test it, but a lot of times I'll have systems that just enter orders which aren't necessarily going to exit right at a bar open or close. I'm not sure if that really answers your question. Francisco has another question. All right. Why don't you use Tradestation Walk Forward app? This is probably something better left to explain privately. Just there's some things that Tradestation does with their Walk Forward that I don't particularly agree with, and I just have a tool that I like better that I've been using. So I've been using this tool that I use, which is called StratOpt. It's like $300. I was using it long before Tradestation had their Walk Forward. They actually bought another company that had a Walk Forward and then incorporated it in their platform. But there's cases where you can use the Tradestation Walk Forward and you'll get pretty similar results, but there's other times where you don't. Why won't that perfect equity curve strategy work? Rick wants it. That's because I trade it myself. No, I'm kidding. Where is it? If I can find it, I think what I did here is I'm assuming, I don't know where it is. Sorry. What I'm assuming with that perfect equity curve, I think, there it is, I think I'm assuming some limit order touch fills, which is the default in Tradestation. It never works though. So, okay. Friend, we got, okay. No, we're gonna have to cut the questions off at this point. So, but I'll stay for like 5 more minutes. The name of that walk forward strategy tester again is called StratOpt. I'll type it in real quick. StratOpt.com. If you go to them, it's just a private guy. Greg's asking, do I run live strategies on local machine or use a broker server hosting to run and execute? I normally do it on my own because I have this incredibly reliable internet connection that goes down maybe once or twice a year. When I go on trips, I'll use a VPS, a virtual private server, and that works out good too. You can do either one. So I use it, and I actually probably crazy a little bit because I do my development and live testing on the same computer running at the same time. A lot of people think that's nuts, but Lewis is saying, hey, great book, but I'm afraid I'm too much of a beginner right now, or I'd sign up today. Yeah, like I said, if you're just a beginner, don't do it. It'll be way over your head. You know, most of the people who take the course are probably probably 2 to 10 years experience. I had some guy who had 40 years. He was like a market maker. So, you know, you want to have at least some experience trading. Okay, and then the last question we have is another one from Francisco. Do you test your markets under different market types and turn it off and on depending on the market condition? There's Van Tharp. You know, I said I agree with Van Tharp on a lot of stuff he says. This is one thing I do not agree with him. Why? Well, okay, I'm going to create a strategy that's going to work, but then I'm going to apply it only to like a volatile bear market. You know, I think he defines 6 different types of markets: a bull market, a bear market, and it can either be a range-bound market, and it can either be high volatility or low. And when you do those combinations, I think you get 6. The problem is you could design a system that works great in a volatile bull market, okay? No problem. The problem is identifying when that is, right? Because you'd only want to trade that system when it's a volatile bull market, okay? I think you follow me here. So when that market switches, then you're going to want to switch to your volatile bear market or whatever is the next, you know, phase that shows up. The reality when you do those kind of things is you have to come up with a really good switching mechanism, something that's going to identify when the market is switched, and then you switch to a different trading system. So you're building 6 trading systems, right? One for each market type, and then you're building this overall controller switching algorithm that'll tell you when a certain market has come on, right? Oh, that is so tough to do because now all of a sudden you've got 6 plus a switcher that you one have to test, and 2 you have to have enough out of sample walk forward data to actually prove it works. I tend to go for, hey, this system just trades all the time, and I live with the flat periods to down periods because I know when it hits its market niche, you know, which I don't even try to identify, it'll pop up. So, you know, I showed you that ES system earlier, and maybe that's a good example of a system that, if I can find it, here it is. You know, maybe it was tuned for whatever kind of market is here and here, but then it had a lot of flat periods. And I don't mind that. I can live with flat periods, even down periods, if I get those big jumps. But, you know, talking about what you're talking about, that Van Tharp advocates, the concept makes total sense, and I agree with the concept. I think the reality of trying to do that is really tough. And I think what a lot of people do is they optimize 6 different systems and then come up with some kind of switching algorithm, which probably doesn't work very well, and they probably end up losing when they do that. So I'd be watched out. I'd watch out for that. Eric's last question. Eric's asking, did that way too long? Not sure what you're asking, Eric. Actually, it's not even a question. So, all right. So with that, I think I'm going to let everybody go, and you will get a recording afterwards, so check your email for that. And again, if you have questions, just, oh, Eric did the Van Tharp switching way too long, so I assume it wasn't successful for you, huh, Eric? All right, so hey, thanks everybody for attending, and if you have questions, email me at kdavey@kjtradingsystems.com. And if you won the book and you're still listening, I will be contacting you to get the book out to you. So, all right. Thanks, everybody. And have a good evening, morning, or whatever, wherever you are. All right. Thanks.